I mean, here's the problem that there's price discovery. The central banks have essentially removed price discovery from all the markets. And so, I mean, everything is just artificially priced. And that includes the price of money. Again, the nexus of all the economic and fiscal problems that the world has is because, the price of money has been determined unnaturally. So where I think this is headed, and it's going to be a rough road between here and there, is eventually gold will be reinstated as an anchor for currency.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to another Silver Doctors exclusive. Today I'm excited to have returning guest, Mr. David Kranzler, the author and creator of Investment Research Dynamics. Today he's joining us to share his thoughts on the global economy as well as the financial markets. And so, Dave Kranzler, welcome back to Silver Doctors.
Thanks for having me back, Mike. I love being on here.
Well, I appreciate you taking time to sit down with us. And of course, our audience loves to get your thoughts on what's happening with the economy as well as the markets. And so I want to basically start off and find out what's on your mind these days. What are you looking at? What concerns you? A lot of things is happening. We had last week, Jerome Powell, markets today. What does Dave Kranzler keep an eye on?
Well, I got to tell you, the Colorado Rockies had the worst July in the history of the franchise. And right now, that's probably most concerning for me. But we're not here to talk about sports. So it's actually a really interesting question because, I mean, if you sort of discard the general propaganda that gets disseminated out there, that gets promoted by the policymakers, our leaders, et cetera, and then disseminated by the mainstream media. And if you sort of pull a curtain away from, the falsehoods that they try to shove down our throat and look at the real data and the trends in the real data, the economic data, the fiscal data, et cetera, I mean, we have everything to be worried about. Not the least of which is the massive increase in the amount of debt, just globally, but specifically in the United States at every level of our economic system. And what really concerns me is I think the general population isn't really aware of that. I think they either don't really care to follow the economic and political news on a day-to-day basis, or they basically consume the stuff that's promoted in the mainstream media. Like, I'd love to see a poll that shows how many people out there actually believe that the true unemployment rate is 3.8%. I mean, I bet you it's a majority, more than 50% would say, oh yeah, well, that's because that's what the Fed tells us. I think just kind of a general, I think, especially if you look at like the sentiment numbers have been coming down a lot. The hope component of it and the future outlook and the outlook for wages, those have been falling sharply lately. And I think the general public knows that things aren't right, and that that things aren't as good as we're being led to believe, or as good as you might think if you look at what the stock market's done since Christmas. So I do think the public senses things are getting worse, but I think just the general awareness of how bad it is, if you really lift up the hood on the system and look at the inner workings of what's really going on. And so, I mean, I know that's kind of general, but it's kind of a long-winded way of saying, I mean, everything worries me right now, from the bad economy to the political bipolarization that's gone on in this country, to obviously the social unrest that's starting to it seems like it's starting to escalate. And I think all of that sort of just reflects how rotted the system is underneath the surface. So, and I do think that between, say, now and the end of the year, between now and this time next year, I do think that there's going to be, I don't want to say a collapse, but I think the system's going to be in a lot worse off than it is right now. I think unemployment, the real unemployment rate, is going to be a lot higher. And I don't think the public's mentally braced for that.
Right.
So,
I do agree. Now, you start off, and within the explanation there, you gave about 3 or 4 things that I took away, and I want to start on the very first one, and it has to do with the debt. And so last week, debt ceiling removed, suspended, whatever they want to call it. It's amazing that whenever the bills are due, the ceiling's raised, or now for 2 years, there's no limit for the most part to what can be done or what can be created. And so that plays into, the need to prop this thing up continuously. And most Americans don't really take account how dangerous this is. Shine a little light on what this debt ceiling removal for 2 years means. What do you see? How much will be brought into existence outside of the deficits we know about? And give us, some scenarios of how this might play out in the next couple of years.
That's the idea of a debt ceiling. That's a beautiful propaganda tool. That's a perfect example of one of the primary falsehoods that gets floated out there, like, the government's limited on the amount it can spend by the debt ceiling. Well, the debt ceiling's non-existent. As you say, ultimately when the bills come due, the debt ceiling gets raised, and now it's suspended for 2 years. Whatever that means, it basically means the government can spend and borrow as much as it wants. But you're looking at, I remember a year ago, the CBO and the mainstream was projecting, an $800 million spending deficit for the 2019 fiscal year, and that was what was promoted in the media, and it's higher than it had been. Honestly, if you look at the spending for the first 6 months of the government's fiscal year, the fiscal year runs from October to the end of September. I think it was something like $780 billion of deficit spending. Okay, so that you're looking at a run rate of over $1.5 trillion of deficit spending, which has to be funded by new debt issuance. So of course they were going to have to raise or suspend the debt ceiling. I mean, I don't think they know how big the deficit's going to be this year. I mean, because when you look at that, most of the cash flow, or the majority of the cash flow, or greater than 50% of the cash flow, is going to flow in the first half of the fiscal year, because that captures your tax season. So, the way that I look at debt issuance, and I think it's the right way to look at it, and no one can refute me on this, is that debt issuance, especially government debt issuance, is no different than money printing. Because when you take out a loan, you're given spending power, and that spending power spends exactly the way printed currency would spend. And that spending power isn't pulled back until you have to pay back that debt. You see what I'm saying? So people have to pay back credit card debt, or face bankruptcy or whatever, or you get a lot of pain in the ass calls from credit collectors. But there are no credit collectors for the U.S. government. So when they're issuing debt at an increasing amount, and it never decreases, when they're increasing debt in perpetuity, that's no different from printing that money, because it spends just the same. Now the apologists will argue that, yeah, but the debt has to be paid back. Well, yeah, but it never is. And so that's the same thing as printed money. And it's the gradual devaluation of the spending power of the dollar. And that's what we've seen since 1971. So essentially removing or suspending the debt ceiling for 2 years is essentially giving Trump a printing press, or the Trump government a printing press.
Yeah. I do agree. Now, one of the second point you hinted on was unemployment, and people coming to realization of what the real figures might be, because I believe eventually it's going to be hard to continue to believe the statistics that are given to us by the government agencies themselves. But yet I read an article recently about, I think it was from analysts from some bank, mentioning that the new round of tariffs might impact employment in reference to retail sales and approximately 7,500 or more store closures, I guess this fall or some time frame. And so there will be a realization that jobs are being lost. So with this tariff situation, this new 10% issue last week on additional tariffs, will we have some impact between now and Christmas, you think? And will that hinder the Christmas spirit, in your opinion?
Whew. I can't speak toward the Christmas spirit per se. I do think it's probably not going to be as pleasant a Christmas for a lot of people, a lot more people than it wasn't pleasant last year. And again, it depends on how lenient the credit card companies are going to be with giving people rope to hang themselves. So, but yeah, I mean, the tariffs are essentially a tax. And the way I look at it is it's essentially Trump shooting himself in the foot, because the tariffs affect his constituent base as much as anyone. And so, it's people are going to have, it's going to take up even more of people's disposable income. And it's going to lead to more retail store layoffs. I mean, the brick and mortar retail store situation is affected both by just the general economic decline, which the tariffs are going to hasten. We were going into a decline with or without the trade war, and I still believe to this day that one of the primary motives for starting the trade war was to use it as a cover story for the deteriorating economy. Because this way, politicians always need a scapegoat. Policy leaders need a scapegoat. So now they can point at China and say, well, China wouldn't agree to settle the trade war, and that's why we're in a bad economy. So, I think between now and the end of the year, things are going to get worse. There's obviously going to be a lot more retail store layoffs. And then, the other troubling trend, and it's right out of Brave New World, is you got companies like Walmart are replacing employees with robots, or even just self-checkout lanes. I mean, when I go to the grocery store, because I don't have to shop for a big family, but if I have a small basket of stuff at the grocery store, I go right through the self-checkout area, and so that right there has just reduced the amount of employees these grocery stores need to hire. And now I guess Walmart's hiring robots to replace a lot of the workers. And that's another general trend that's going to affect the overall level of employment.
Yeah, I do agree, and it's unfortunate that a lot of people don't see it coming right before their very eyes. Now, I want to get your thoughts on last week FOMC meeting, up until that, I guess, 2:30 announcement, or the speech that was given, and the Q&A afterwards. It seemed a little bit different than prior years, because people were actually asking questions that seemed like they had a little bit of emotion behind it. Not sure, did you get a chance to watch it? And what are your thoughts on the quarter drop? Is that one of many to come this year, you think?
That's interesting. One thing that irritated me that Powell said, and I don't watch the press conference. It's a zoo. It's a three-ring circus. I don't pay a lot of attention to the whole event, other than, I want to see what their policy decision was. And then, I read the bullet points, the main points to policy. If there's policy changes, I want the main takeaway from that. And so it was the quarter-point rate cut, and then the fact that they're going to stop shrinking their balance sheet 2 months early, which I thought was the more significant part of the policy decision. Powell said, "Well, this isn't the start of another interest rate, a lowering cycle, whatever he calls it, a rate reduction cycle. Those tend to happen over long periods of time." And in one sense, that's correct, but in another sense, it's completely wrong, because, I ran some numbers that I put in my short sellers journal, and it took them about 17 months to take the Fed funds rate from 5.25 down to essentially zero. And so that happened in 17 months. It took them 7 years before they started raising rates again. And now they're back to cutting cutting them again. However, if you look at the big picture, you go back to 1981, we've been in a rate reduction cycle since, since 1981, when after Volcker yanked up the Fed funds rate, I guess to 18%, I think it was, something like that. And then immediately afterwards, they started lowering them. So, and it's just been a general cycle of the Fed funds being lowered over time. So, yeah, I mean, to that extent, we've been in a 38-year rate reduction cycle. So, but I think he's talking about more in the median sense, where they raised rates for a while. Well, they didn't really raise rates. It took them forever just to get up to 2.5%. Now they're cutting them already. And originally, the original thinking behind QE was that they would print money, throw it into the system stabilizes, and then they would remove that money. The whole system was set up to remove it. And they've only removed about a quarter of it, not even less than 25% of it, and they have to stop removing it. So that just tells you fundamentally and structurally how bad the economy really is. Especially they can't even, it was literally in January when they announced that they were going to stop shrinking the balance sheet at the end of October. And here we are, 6 months later, and they have to stop shrinking the balance sheet 2 months early. I mean, in the SOMA account, which was basically the money printing account where they printed money and bought treasuries and mortgages, there's still something like $3.6 trillion worth of securities in there that are going to stay in there ad infinitum, it appears now.
Yeah.
And ultimately, I think that, when you stop shrinking the balance sheet and you run out of room to take rates from 2.5% down to zero, they're going to have to start printing money again. I mean, they're going to have to figure out a way to fund all of the new treasury issuance that's coming, because I don't think foreigners are going to keep funding it.
Right, I agree. So they stopped tightening, and so they're going to be easing. And so, do you think they're going to ease at a somewhat at that former, was it 50 billion a month they bought, securities or whatnot? So do you think them starting that again or doing something a lot more, in your opinion?
I don't know. I kind of watch the Fed like this. It's like watching a train wreck in slow motion, and there's nothing you can do about it. And they're going to come up with some sort of, the idea of quantitative easing was a creative propaganda term for what was essentially money printing. The Fed created money, threw it in the system, and most of it's still in the system. So, and MMT, maybe they'll adopt MMT, which is really essentially de facto money printing. So, I have no idea what the next round of money printing is going to look like. I'm not sure they can take interest rates or the Fed funds rate negative, but they're definitely going back down to zero at some point.
Yeah, I was looking at just trying to do some calculations myself, and I think I calculated approximately 9 quarter point drops that I guess they could do incrementally over time if they choose to do such before we get to zero. Now, the question is, will they stick to that quarter, or will they have to go a lot more drastic? Like, I know President Trump, wants a full 100 basis points, but it's no question how it's going to pan out, but it's going to be ugly. And so in the future, along with that, gold prices last week spiked as well. So it looks like the same time frame that the FOMC gave out their statement, the price of gold globally went up in a variety of currencies. Is this an ongoing trend, do you think, because of all this uncertainty because of monetary policy?
Well, I think the Fed's monetary policy is certainly in the mix of ingredients, but I think there's a lot of variables that are influencing the price of gold: the trade war, the escalation of geopolitical tension, just general. A lot of other central banks around the world had never really stopped printing money. So, and actually, in most currencies around the world, gold is at all-time highs. So, and that's because of the money printing policies and everything else going on. So, it really, in priced in terms of dollars, the U.S. dollar price of gold is just now starting to catch up, and I think it's going to catch up pretty quickly. Like certainly a lot more quickly than I would have expected. But the Fed backpedaling on its original promise to remove money and normalize interest rates. I mean, that was the other thing over the last couple of years. They keep redefining what the term normalization means, and that's what, again, circling back to what we talked about at the beginning, that's what concerns me about the general public is, I mean, people don't have time to take the time to understand what all of this means. So I think as a default, they just kind of, the Fed's an expert on this, so I'm just going to have to put faith in what he says. So if he tells me that normalized interest rates used to be 5 or 6% and now they're 2%, then that's what I'm going to have to accept. So, I mean, there is really no definition for normalization, and certainly human beings can't replace what should be allowed to be priced by the market as opposed to humans. And we've had a long period of time now where human beings have been putting a price on money, and that's what's caused our problems. That's the very root of our problems.
Right.
Is leaving monetary and economic policy in the hands of humans instead of letting the market determine what it should be.
Right. Now, I want to get your thoughts on, as a response, it looks like, to the tariffs. I'm hearing and reading that China decided to allow the yuan to return to, I guess, what's considered relatively low figures that hasn't been seen since 2008. The yuan is about 7-1, the exchange rate. And so do you think this is a deliberate response to the tariffs, or is this a part of a different plan on the Chinese part, or what? What are you reading into this?
Depends on who you believe. If you believe Trump, he's saying the Chinese are manipulating their currency and driving it lower. If you believe the Chinese, they're saying no. We're not driving our currency lower in response to Trump's imposition of tariffs or Trump escalating the trade war. I mean, here's the problem: that there's price discovery. The central banks have essentially removed price discovery from all the markets. And so, I mean, everything is just artificially priced. I mean, how do you put a valuation multiple of, I don't know, what is it, like 150 times revenues for Beyond.com? I mean, it's got 80 million in trailing revenues, or 90 million in trailing 12-month revenues, and it's got a multi-billion-dollar market cap. I mean, that just tells you there's complete absence of price discovery in all the markets, and that includes the price of money. I mean, the price of money is essentially determined by the cost to, you lend me $1, and then and you tell me how much you want in return for lending me that $1. Say I got to give you $1.05 back. That's the cost of money. So when you have everyone in the whole system setting the price of money that way, that's the market setting the price of money, not human beings. And so, I mean, what's the natural exchange rate for the yuan versus the dollar? I don't know. No one can tell us that because it's been artificially determined for so long. It's just like the U.S. dollar. I mean, the U.S. government labels China a currency manipulator. Well, we've had something called the Exchange Stabilization Fund that was established, I believe, in 1936, 1935, somewhere back then. And it was established for the purpose of stabilizing foreign currency exchange rates, keeping the dollar stable. And that's essentially a fancy way of saying the government will intervene in the currency markets when they think the dollar's getting too far out of whack relative to other currencies. So, again, the nexus of all the economic and fiscal problems that the world has is because the price of money has been determined unnaturally. So where I think this is headed, and it's going to be a rough road between here and there, is eventually gold will be reinstated as an anchor for currency.
Now, do you see that happening within the next? I mean, do you think that process being sped up because of everything that's going on, or was that going to be the natural evolution of currency anyway, to get back to something sound and stable to measure value in the form of gold?
I mean, it's just one of those things where a trend happens gradually. A trend that leads to a change happens gradually, and then it happens all at once. And I think we're on the edge of something like that happening all at once. Now, how long it takes for that process to play out is anyone's guess. I have no idea, but certainly what's going on around the world and what's going on domestically, politically, socially, economically, financially, they're all signs that we're getting close to that all at once point. And that's where you're going to get a big reset that everyone alludes to. And how ugly it's going to be or what it's going to look like, I have no idea. I mean, my biggest fear in that regard is that there's going to be some sort of major global military conflict that breaks out, because that always seems to happen when you get to that all at once point.
All right. Now, as we draw towards the end of our discussion, I want to get your thoughts on some recent news in reference to the whole stock market and the bond market as a response to all this trade stuff. So it looks like the Dow's down, close to 600-700 points as of today, as we're speaking. And so is this the beginning of something that's going to, continue on, or will it spike back up tomorrow as if nothing ever happened? Or what's happening in the stock and bond market right now? Is confidence really starting to be questioned?
Again, I mean, the stock market is in the middle of the biggest stock bubble in the history of this country. I mean, all the stock markets around the world have been in a bubble, and it's a function of all the money that's been printed and all the credit that's been created. So, again, and I said this leading up to 2008, and the S&P I think was around 1,500, and I said, the S&P could get taken down to 300, and it would be at that point where it would probably approach a fair valuation based on using historical PE ratios when markets bottom. But they didn't let the S&P get down that far. It got down to, ironically, 666 is where the S&P bottomed out. So it got pretty close to my target. It was certainly a lot closer to my target than it was from where it topped out at 1,600, whatever the number was. And so, but like I said, they didn't let it reach a point of fair valuation. That's when they started printing money, right? They started printing money, and the S&P bottomed about, 3 or 4 months after the money printing program started. So, again, I think how low the market goes this time around is going to be a function of the degree to which printed money can be used to keep the system propped up. And, don't make no mistake, they're probably in there today, at least trying to slow down the rate of descent of the stock market. So, and again, everything is so artificially, everything ran up so artificially with all of the technology and that you read about, the hedge fund algorithms, the computer trading, et cetera, that it's like a coiled spring, it's a coiled spring that someone's holding upside down, and there's no telling how violently it could go to the downside. And there's no telling the degree to which attempts to cushion the downside are going to work. So, but again, and I make this point, and I really don't hear many other people ever talk about it, but it's one of those things that it's a white elephant in the room that everyone ignores. I mean, the accounting standards have changed so vastly between now and 1999, so that if you were to apply GAAP accounting standards to the S&P 500 earnings, the earnings that the earnings per share for the S&P that you would arrive at using 1999 GAAP standards would probably be, 30 or 40% lower than they are now. So again, if you were going to go through the exercise of calculating how those earnings would have been calculated in 1999, and then apply a bottom of the cycle PE ratio, which would get you down to about a 5 or 6 PE ratio, which is about where markets have bottomed out historically, you'd probably be looking at an S&P 500 that would be well below 1,000. And people probably think I'm crazy for saying that, but it wouldn't surprise me to see it, eventually at least a 50% sell-off in the S&P, which would take it down to about 1,400. But I could easily see it going below 1,000. And again, I don't want to put a time frame on that because it's not going to happen right away. People can imagine.
Yeah, and that's one of the things where, because we've reached a point of extreme radical monetary policy, I would never say what couldn't happen in real world terms in reference to the manipulation. When it ends, how bad things could really get. So 1,000 to me, I would say I'm not even savvy as you when it comes to those type of figures there, but I would say it has to go probably a lot lower than that because of how inflated everything has become. So
right.
Yeah, that's just my little 2 cents. But Dave Kranzler, it's been great having you here on Silver Doctors. Any last thoughts you want to leave us with? Anything else? And definitely we'll look forward to connecting with you again and get your thoughts down the line and see where we're at that point. But any last thoughts you want to leave us with?
You're assuming people want to hear my thoughts, Mike.
They do. We enjoy hearing it.
Again, I would say to the extent that people have money out there that they're looking to invest, buy physical gold and silver and keep it under your mattress. Don't leave it in a bank safe deposit box. Don't leave it in a depository somewhere. I think we're entering one of those periods of time when you need to be concerned about the return of your money, not the return on your money. And if you're heavily invested in the stock market, you're gonna learn how negative the returns on your money can get if you leave your money in the stock market. And fixed income CDs, those are worthless. Those are paying a lower interest rate than the real inflation rate. So I was running some numbers earlier. Since gold bottomed out at 1,050 in December 2015, gold's up 44%, 44.6% since then. It's up 14.6% since mid-November 2018. So, for an investment or an asset that's supposed to function as wealth preservation, those are pretty damn nice gains on your money there. And I think we're going to continue to see returns on gold and silver like that going forward for a while.
Dave, enjoy the rest of your day. Look forward to connecting again in the future.
Thanks, Mike. Look forward to talking with you again soon.